Welcome to the podcast, Eliot.
Happy to be here. Thanks.
Okay, so let's kick it off by giving listeners a little bit of background. I went to your LinkedIn profile. It looks like you went to college and then you started Plastiq. Was that, just tell us a little bit about sort of, what you did prior to Plastiq and what sort of was, you decided to become an entrepreneur right out of the gate.
Right. Yeah. I like to tell people probably I was unemployable, right? But no, all jokes aside, I mean, you don't, I've learned you can't, what is entrepreneurship? You don't really force your way into it. You kind of stumble into it sometimes, naturally with a little bit of luck. And in my case, that was kind of what happened because the early roots of Plastiq started with my own problem that I was trying to solve. Frankly, I had no idea whether it would be applicable to others or a massive business. It's not like I sat in front of a whiteboard trying to come up with an idea. In my experience, at least, most of the successful ideas out there start as just a unique problem that one is trying to solve, and they evolve from there. And so that's how Plastiq started. And I think before that, I was always growing up a little bit of I'll call it a tinkerer, right? I always sort of played around with things. I had some small, I don't call them businesses, let's call them projects from a very early age. And so now kind of looking back, all the patterns make sense. I always was trying to solve different problems in my life, and Plastiq was no different.
Mm-hmm. So then what was that initial problem that you had personally that you were trying to solve that led to the founding of the company?
Sure. So it was kind of the confluence of two different problems in a way. One was, so I'm from Canada, so I came to the US for school, and being new to the country, I had no credit score. And so credit was obviously it's foundational to the country and to access a lot of aspects of your life. And so I sort of went to try and build my credit score. One way to do that is to basically take out a credit card and use it responsibly and pay it off and establish a score. And so I went to take out my first US issued credit card here in the country because I was new. And I went to pay at the time what would be a very small piece of my tuition as a student. And I was told, hey, I was told I couldn't pay that way. And so I didn't know anything about payments or even credit cards really, except I was a consumer of them like billions of consumers in the world are. And it just struck me as disempowering or at least odd that I couldn't pay, using this familiar instrument. And that set off sort of the question mark in my head of like, why can't I pay the way I want? And it's obviously evolved, 100-fold, like many ideas since then.
Mm-hmm. Right. So you obviously you launched a company. I've used your company as a consumer, and so doing with the same thing that you just described there, and obviously you now when we look at your website, you're much more of a B2B company. So just maybe take us through the evolution from focused on consumer to to the small business.
Sure. So, like many businesses, right? I think it's often wise to follow the customer. I mean, the customers aren't always right, but I'd say if there's a pattern over time, certainly it's often indicative of sort of an interesting concept or a new problem that one should try and solve. The reason why I highlight that is I'd say the main reason we evolved from, as you mentioned, starting as a consumer-facing payments platform to much more of obviously focus on SMBs and B2B overall is because when we first launched, we saw that consumers would use us occasionally for a tuition payment, which was my founding use case, or maybe a rent payment or a tax payment, right? Common household bill pay, if you will. But small, medium businesses started to discover us organically, and they started to use us for I'd say a much greater holistic use case, which was fundamentally to run all their accounts payable. And so I'd say, I'll phrase it as the following. Categorically, if you think about the problem, the higher level problem we're solving for consumers, it's more of a convenience, maybe a rewards problem, right? Which is interesting. But for small, medium businesses, it's really a problem of cash flow and credit. And if you talk to any SMB in America, the number one thing top of their mind every single day is working capital. And so it's a little bit of call it more holistic, I'll call it sustainable, and therefore, frankly, a bigger problem to solve.
So you went from having like small businesses discovering you and using their credit card to pay something that they couldn't pay by credit card. What's the and obviously that's a cash flow. A lot of them were using it for cash flow. Some were using it probably just for points as well. But where did you sort of suddenly see, well, we really need to address this financing issue head on?
Yeah, sure. I mean, I'd say the types and natures of the payments that were being made is really where we realized the problem was much more than just rewards or convenience. I mean, for example, we would see credit cards that were being used on our platform that were not your typical 2% cashback type cards, meaning it was obvious that the user who was making a payment on Plastiq was clearly not interested in rewards, because they would use a card that had no rewards, right? Unlike others that were using the service for rewards. And so that was an obvious example of like, okay, well, clearly there's a bigger or different nature of the problem here. That's one. The second is, I'd say, when our customers our small businesses started coming to us saying that they wanted to use us not just for their accounts payable using their existing credit card, but they wanted to use us to help find additional sources of credit, and actually viewed us not just as a bill pay product, which is what a consumer would view us as. They viewed us as more of an accounts payable platform for them to automate their business in general. So different words were used to describe I'd say the product between consumer and SMB. One was more limited, occasional use bill payment. One was more, this is a platform to help run my business overall.
Mm-hmm, mm-hmm. Okay. So can you take us through sort of the product suite today? What do you offer?
Sure. So fundamentally, similar to our roots, I mean, the business has evolved a lot, but our DNA has still remained largely the same, which is the majority of our volume, our payment volume, our revenue, our customers use us for our flagship sort of product, which is what we call Plastiq Pay. As the name implies, it allows a consumer, or in this case, 90% of our use case, as we just discussed, has evolved to small, medium businesses. It allows users to run all their accounts payable, all their vendors who don't take credit card on Plastiq, so that they can access that sort of short-term working capital by using their existing Visa or MasterCard or American Express. They're getting 30, 45 days of float. That's the dominant product that customers use today. However, what has started to evolve specifically in the last 8 or 9 months, so quite recent, is we have 3 or 4 other sort of flagship products. One is we actually launched our own short-term financing product. We use a couple different partners for this, but this product basically, in the context of a payment, a small medium business using Plastiq will be prompted to select an installment or sort of payment plan for that payment, and they can choose to use a credit card like they normally do on Plastiq, or they can choose this short-term financing product directly on Plastiq to sort of push out the payment further than, say, the 30, 45 days you would on a credit card. Instead, they might have 2, 3, 4 months to make those payments using our short-term financing product. That's one of the new evolutions. The other is what I'll phrase generally as payment automation. So what does that mean? Anything, as the name implies, to help automate sort of the back office of small medium business. So invoice ingest, so they can snap a photo or send or forward an invoice to our system so that it automatically scans it, imports the bill to our system, versus having to, say, manually add vendors or invoices one by one. Accounting integration. So we're integrated to most of the major accounting providers like QuickBooks and many others, so that a small business can import bills from, say, QuickBooks, but also export all their payments back into QuickBooks. So it's a bilateral sync, again, designed to automate things that otherwise might be more manual, to save the business time. That's the second. The third that's probably worth highlighting is, not surprisingly, a decent number of our customers, as they started to use our product to pay bills, hence I labeled the product Plastiq Pay, then came to us saying, hey, I also have a need to receive money, right? Because money in, money out is sort of the math of most small, medium businesses. And so they came to us asking for a way to basically automate their accounts receivable and allow them to invoice their customers or collect money from their customers and offer them a new payment choice. So we've had quite a bit of success with that product, which we call Plastiq Accept, hence, the nomenclature to accept money in versus pay money out. So those are a few of the products that we now offer. There's a final one, which is less of a product aimed at the SMB themselves. It's more a product aimed at platforms who have SMBs, and we call that Plastiq Connect, which is basically our version of a white label API product that I'm happy to touch on.
Yeah, so let's just dig into that for a minute or two here. So how did that kind of come to be? Was this sort of something that people were requesting? You saw a market need. What was and maybe you can describe it in a little bit more detail.
Yeah, sure. So this product, it came somewhat out of customer demand, but also it came a little bit out of sort of our vision or how we see the space, the B2B space, broadly speaking, evolving. So if you fast forward the clock, and if we're right, we may not be right, but if you fast forward the clock into not just short term but medium long term, 5, 10 plus years, and you look at the different ways the landscape may shape out, one of our theses is that everyone's becoming a fintech, and or phrased differently, companies that historically have not touched payments or certainly haven't tried to monetize payments are now realizing that it's a potentially lucrative way to drive additional revenue streams. And so for that reason, we believe there will continue to be a convergence, I'll call it, of players that otherwise used to not partner or not compete start to sort of converge together. And what that means is either in our view, you have to be able to offer all the solutions and products and features that these players who historically you didn't have to compete with, you now over the 5 to 10 year span, you will have to compete with, or, which is more our approach, you can say, let's come up with products and features that these other stakeholders, these other players can consume, can plug into, can embed, so that we don't have to necessarily expand or compete, but instead we can partner. And so it's phrased in a different way. It's really our sort of approach to call it embedded finance, and right. The product therefore does exactly that, which is if I'm a platform that has 50,000 small medium businesses, let's say I'm in an adjacent space, insurance, so I provide insurance or I provide payroll to those 50,000 SMBs. Well, next I want to start getting into bill payment or banking or accounts payable. Well, I could choose to buy a company, I could choose to build over time, or with Plastiq Connect, I can simply, with a few lines of code, choose to sort of plug in and partner. It's sort of our approach to call it Stripe for B2B. Those are a few ways to describe it.
Right. Gotcha. Okay. Interesting. So then on the payments processing side, it sounds like, what you've got, like you said, that companies want to be able to accept payments. What, I'm curious about what you're offering there specifically that, like if they have QuickBooks,
Sure.
QuickBooks has a payments processing, there's lots and lots of different payments processes out there. What is it you're providing that is different?
Yeah, a few things, but fundamentally, there's one major difference, which is important. The payments industry, as it relates at least to credit card acceptance, for 5 or 6 decades now, has fundamentally been focused on one primary value proposition, which is convincing merchants, the receiver of the funds, that in order to accept credit card, they should be paying a fee, right? Interchange and a markup, so 3-4%. That's how the industry has done well, has run for 5+ decades. Our entire approach is the exact opposite. We believe that there's, part of the $9 trillion market size of B2B payments, the majority of it does not run on credit cards, for the reason that the merchant, the recipient, has no interest nor ability to eat that type of fee. And so we reverse the fee. Our belief is most of the ecosystem can support what we call a buyer-funded model versus a supplier-funded model, the merchant-funded model I just described. And so our Accept product, different than, say, standard merchant processors or the QuickBooks of the world, who have their own merchant processing product, as you alluded to, is if you can use QuickBooks, it's a good product to accept credit card, but you're going to pay 3-4%. With Plastiq, as a recipient, it's free, right? The fee is borne by the buyer. And so it's a dramatically different mathematical equation for arguably a very different type of customer than others are going after.
Interesting. Okay. So then, but how are they processing the transaction then? Like, are you processing that transaction for them?
Yeah, so we are sort of the master merchant, the merchant of record, the processor for whether the customer comes to Plastiq as a buyer or whether they use our Plastiq Accept product as a supplier or a recipient. We use the terms interchangeably. Regardless, that payment is being processed on our rails.
Right, right. And so so your rails then have to go. You're paying the fees to the networks, right? And obviously you obviously put a markup on that for the buyer. I mean, is that, I guess, from your perspective? I mean, I imagine if you're doing a lot of credit card transactions, right? So, are you like, I guess from what I'm trying to get at is how much more is the transaction going to cost? Obviously the buyer is paying the price. Is there, like, I guess what I'm getting at is we have become used to the fact that credit cards don't cost anything when we're using them. Right? You go to Starbucks, you go to the local store and you put your credit card on. You don't pay any different. What's that like? Is there a resistance on the buyer side to that, because you're flipping the model on its head?
Right. Yeah, it's a good question. I'd say it's different for consumers than SMBs. I would agree with you. As consumers, we've been habituated to usage of our card. Of course, it's a privilege we are entitled to and should never cost us anything. Even though in reality, we all know, those in the industry know, all those fees are passed on in some way or another. They're built in, they're marked up. Now, of course, surcharging is much more prevalent, so they're seeing a lot more of that directly. That said, for SMBs, so two comments. One, I'd say that because the value prop, we started this conversation sort of talking about the evolution from consumer to SMB, and you asked why, and rightfully so. And the main reason I answered why was because categorically there are different value props. Consumers solving for convenience, rewards, which has a finite mathematical calculus to it. If you're solving for cash flow and credit, I argue there's a finite calculus, but the calculus is much bigger because it's, can I get some extra miles to fly my family to vacation? That's nice. That's a nice to have, right? But as a business, it's, can I survive another month, or can I double down on inventory to help grow my business? That's not a nice to have, that's a must have. And so my willingness to pay is going to be proportionally much greater for a must have problem and solution to that problem than a nice to have problem and solution. So that's one sort of more cerebral way to think about it. I think also it's important to note that some of our SMBs don't necessarily need to use us for all their payments. And so the reason we've evolved now, you asked earlier about 3 or 4 of our other new products, the automation products with connecting to accounting software, or the invoicing products, or our own short-term financing product, is because some SMBs want to use us for a few of the payments, but then they also want to use our other products that aren't necessarily charging the same type of fees.
Right. Gotcha. Okay. That makes sense. And, and businesses, obviously, they're not as, I mean, they will see the value, whereas the consumer just, we've been conditioned to sort of ignore the value that the credit card provides. Yeah.
And again, it's all how you describe it. If for a consumer, we can only, the value prop is, hey, pay 2.5% and get a bunch of miles. That's a reasonable value prop. For the SMB, it's use Plastiq to float for 45 days. And it's the cheapest form of short-term capital in the market. Cheaper than a bank loan, cheaper than any other loan. And so it's hard to beat that value prop.
Right. So then, who is using the? Do you have a typical kind of small business customer? I mean, are you focusing on any industries? What's who's using it?
Yeah, a few common threads to pull on there, perhaps. One, I like to tell our investors that we serve. We're primarily, although not exclusively, primarily based in the Bay Area, which is great. But I'd say I like to tell our investors we serve. Our customers aren't like us. We serve real America. Your typical small medium business. We're probably a little more on the M of the SMB spectrum versus the S. What I mean by that, let's put some numbers on it: 500K to not 50, 500K to 15 million of revenue. So, pretty established SMB. They might have 5 to 25 employees. They're not a venture capital funded startup. They've been around a few years. They have access to credit, but they still have constant sort of short-term working capital needs. And that gets to the question you asked on industry. No, we don't really have any concentration, but I'd say if you asked sweet spot focus-wise, a lot of e-commerce, that's obviously only growing because the macro trend is there's more e-commerce companies happening because people are leaving their day jobs or are realizing what's important to them, right, post-COVID. And so you're seeing a lot of these companies and entrepreneurs that always wanted to start their business now are, and they're doing so in an e-commerce way, which helps us because that's a big industry for us. Wholesalers, resellers, we see quite a bit in the construction. The common link here is there's a heavy reliance on supply chain where they're buying inventory in bulk and then having to sell it, which means if they're buying from you, they're having to pay you today, but then they're not, we aren't buying from them for a month or two. So there's a revenue sort of gap they have to solve for, and Plastiq happens to be a really nice, elegant and easy way to do so. Right.
And I want to go back to what you said about the price, the cost though. You said this is cheaper than bank capital. I'm just curious about what do you charge and how is it cheaper?
Yeah. Well, I should be also clear or fair, which is one of the fundamental problems in the first place is for your classic SMB in America, the banks aren't, lending to them, right? Banks are focused on the commercial loan side. It's much more profitable. The mortgage product, much more profitable, which is totally fair. It's up to the bank. So there's almost not even a comparable, but the math still is pretty hard to beat, which is as follows. A typical small business is using us. They're paying somewhere between 2.5 and 3%. Let's just make it easy. Let's call it 2.75%. Okay, 2.75%, interesting. And then they're often using some type of rewards cards, maybe not as rich as consumer cards, but there's plenty of good examples out there of small business cards that are giving 1.5%, 2% cash back. And so all of a sudden, the net cost, you're 2.75, you're down maybe to 0.75, maybe 1% after the rewards that you get from your card. You then write off the fee. It's tax deductible. Nothing to do with me. This is just IRS guidelines. So all of a sudden, you're 1%, depending on the state you're in, for tax or federal tax, state tax, you're down to 50 basis points. And then, also, in some cases, you're getting us a discount from your supplier because it turns out a lot of suppliers offer early payment discounts, the equivalent of classic 210 net 30s, it's called. And so a lot of our customers are paying close to 0 to maybe 0.5% for 30 or 45 days working capital. Well, even if it's 0.5%, you put that on an equivalent APR basis. Well, 0.5% for 45 days is 4% APR for an instant loan. Not something that's easy to compete with.
Gotcha. No, that makes sense. So, I want to switch gears a little bit and talk about some recent news. You recently announced the intention to go public via SPAC. Obviously, that was really popular a couple of years ago. It hasn't been as popular this year. What was the impetus behind the move to do it now?
Yeah, right. I mean, some potentially a little controversial, and I'll have to sort of speak at a high level here because obviously the deal is still in process.
Sure.
But I mean, at a high level, listen, the thinking was the following, which is if you think about, there's a few things, but if you think rewind the clock this time a year ago, like you said, thematically, the world, money was never cheaper, right? For anyone, business, consumer, right? We're printing money. Why is that important? Capital was not a competitive advantage for a late stage startup because any successful late stage startup could raise whatever they want. That has flipped on its head, and now capital is extraordinarily scarce and very expensive if you can find it. So our thinking was, if with the right SPAC partner, we can sufficiently capitalize the company with a war chest of capital, then it becomes all of a sudden a competitive advantage that it wasn't before. That's one. So it's a financial currency that historically was a commodity and now is actually very rare. And so we believe it's a way to leapfrog some of the market that's out there. So financial currency is one. The other is, I'll call it more of a social currency. And what I specifically mean by that is we're 8.5, 9 years into this game and we're in financial services. Many industries, reputation, trust is important, no doubt. But in movement of money, it's arguably, the stakes are very high. And a lot of our growth and our success has come from our ecosystem partners, the banks that we work with, the fintechs, the platforms, as we expand the Plastiq Connect product that you and I briefly talked about earlier. Why does this matter? There's a stamp of rigor and approval of being a public entity versus a private entity almost overnight, that we believe will give sort of this social currency to attract, or to continue to attract, the success of our growth with partnerships in the ecosystem, which is part of our moat. It becomes a currency for talent, because there's there's increased skepticism, I'll say, in the talent market of late stage private startups that have gone out of business and were mostly smoke and mirrors. Well, there's a stamp of rigor of being public that we believe will become an advantage competitive wise, not just in the market, but with talent and other things. So those are a couple of the reasons, contrarian wise, to do it now versus a year from now.
Right. Okay. And obviously you can see, we can all see every day the fintech companies that have gone public. I mean, right now every company is down pretty much this year, but the fintech companies have fared worse than the averages. I mean, I presume, obviously you're fully aware of that story. Are you concerned that suddenly you're going to be, it's not about one or two investors thinking this is what you're valued at. It's about everybody.
Yeah.
How do you kind of approach that, knowing what has gone before you?
Yeah, it's a good question. I mean, I think it takes a little bit of a thick skin, or I'll phrase it differently. One cannot be myopic. You have to take a long-term view here. And that means that, in the long run, right, markets are transparent and they're efficient. They always have been. And the public markets, that is. Private markets, no secret, it's always been, it's monopoly money until it isn't. And that's fine. But I think our approach is going public is, the day one is a moment in time. And as I've told my team and board and investors, no one should even look at the value for until 18, 24 months out, right? We want to get out for the reasons I just mentioned. And over time, markets are efficient. And if you execute on things you can control, you can't control the market, as we've learned, and that's fine. If you execute on things you can control, delivering new products to customers, right? Attracting, retaining good talent, properly capitalizing the company. If you control those things well, the markets in the long run will reward you.
Right. I think that's fair. I mean, obviously, if you're profitable and growing, eventually the investors will find you. So, assuming you get the SPAC closed, I mean, and you raise a war chest of capital, what are your plans for that? What are you planning to do?
Yeah, I mean, generically, a few things. I mean, you and I talked a little bit about our new recent product additions on the heels of sort of our flagship DNA, which is our core, accounts payable bill pay product. We have a long ways to go in terms of feature development that our customers are asking for on those other products. We're going to continue doubling down on that. We're going to double down on the embedded sort of API play, what we call Plastiq Connect, that you and I briefly spoke about as well. Because it's early innings there in a good way, right? And I'd say we're selectively going to look at some M&A, right? And not geographically probably, because again, there's nine odd trillion dollars of market size, which is plenty for a while for a lot of players in the U.S. But we may look at some M&A from a product synergies perspective, some neobanks type of stuff there. And then of course, one of the most perhaps remarkable aspects that we've achieved as a company is, we've grown, getting close to 100 million net revenue on an annualized basis, and we've done that with very, very minimal go-to-market motions on sales and marketing. And so we are going to dramatically expand a lot of our efforts on that front to, continue to bring these products I just mentioned to the market.
Right. So then, are you planning on? Obviously, you're going to be launching new products. I mean, do you see yourself as sort of a champion for small business? Is that, like you talked about, Main Street? What are your, how do you view, where do you fit? How should we look? How should a Main Street business think of you?
Yeah, I think we do serve, nearly a couple 100,000 SMBs that are more, everyday real American SMBs. And, every product we build is in service to help those SMBs, what we call reach their growth potential, right? Making small business big, if you will, right? They're often viewed, there's no reason why they need to view themselves as a small business. And so making small business feel big is important to us.
Right. So with that in mind, the last question then, what's your vision for Plastiq? Where do you see this in 10 years time?
Sure. Yeah, big question, but it's a good one. I think earlier I mentioned about, again, fast forwarding the clock, right, 5, 10 years out, where the tectonic plates of B2B are going. There's no world in our view where, again, everyone's not embedding and being part of the ecosystem. So while today a lot of our products and features are geared at directly targeting SMBs so they can use our various products, running accounts payable on credit card for short-term float, managing their invoices, connecting to accounting software, right, accepting payments through our Plastiq Accept product. Those are all nice to have products. In the far future, though, we believe SMBs will do business from all sorts of platforms that don't even exist today. And so in the long run, 10 years, I actually view us more as an infrastructure play, more as, call it the plumbing behind some of the accounts payable needs of any provider that wants to monetize their SMB base, whether it be banks or fintechs or payroll companies or insurtech companies, et cetera.
Interesting. Well, I wish you best of luck and good luck on the SPAC as well. And thanks so much for coming on the show today, Eliot.
Of course. No, thank you for having me. My pleasure.